So the overview is we want to understand the genesis of the crisis from an economics perspective. So this is not, Martin, a defense of economics, but it is going to be an attempt to use tools to figure out where did the failures happen. Okay? Where did people have the incorrect incentives that led things to do what happened? Okay, there were obviously lots of market imperfections here, and we'll talk about what some of those are. The incentives in an originate to securitize mortgage finance system amplified the existing market imperfections. The originate to securitize is the idea that the person who decides whether you get a loan or not is not actually the person who funds the loan. That's what we mean by originate to distribute. And there are usually two mechanisms for doing this. There's the broker mechanism. And in the end, brokers actually don't have final approval over whether you get a loan or not. It's the lender that does. Now, the lender may not keep the loan either, but the broker comes and basically takes a application from you and shops it around to a bunch of lenders and sees if anyone is interested. Okay? And until 2 years ago, if you were a broker and you had a borrower with a pulse and you shopped the mortgage around to lenders, everybody was interested. Okay? So that's the broker model. Then there's the correspondent lender model. And what the correspondent lender does is both take the loan application and have the authority to fund it with money that's not that lender's money. So you'll have institutions like Countrywide and Countrywide Capital. Okay, Countrywide was the savings and loan. Countrywide was the place that had deposits, that had stuff in portfolio, and so on. Whereas Countrywide Capital was this correspondent lender, which basically meant they could park Countryside's money to fund the loan for a bit, but ultimately it would be sold off somewhere else fairly quickly. So they basically were acting as a broker, but specifically for Countrywide. Okay, so again, to confess our sins, I thought there were many aspects of the originate to distribute model that were terrific, though the incentives issue disturbed me for a long time. But the idea that you could have capital from around the world funding home mortgages in the United States seemed like a very appealing thing to me. And when people talk about, oh, the good old days where it was relationship banking, well, the good old days of relationship banking sometimes meant that if your skin color was wrong or your sex was wrong, the bank wasn't interested in the relationship. So let's not get too sentimental about, the George Bailey days where, you knew your neighbor and that's how you made a decision about lending. There was something, I think, very innovative and important about the idea that a Swedish pension fund could invest in an American mortgage. And I think that that is something that will come back at some point. I don't know how long from now. But that, in many ways, it was a good thing. But the problem was the incentives of the broker were not aligned with the pension fund, and that led to some bad things. And then concludes with some policy options with respect to the retail market, the securitization market, and some thoughts about some of the policy proposals floating around at the moment about how we're going to deal with this issue. Okay, so the economic forces here. What were the market imperfections in the mortgage finance system? And I'll talk about each of these at a little bit of length. Okay, asymmetric information all over the place. So having just dissed economics a little bit, I mean, the thing about economics, the stereotype about it that's wrong, is you move outside of the neoclassicists. You have plenty of people who've been looking at market imperfections for some time now. And people have won Nobel Prizes like Joe Stiglitz and George Akerlof that takes really serious looks at how people actually behave when confronted with incentives as opposed to how they would behave in an idealized market. And of course, Daniel Kahneman, who's a Princeton psychologist, won the Nobel Prize in economics as well for his look at how people frame decisions and how that framing leads them to make certain decisions instead of sort of the classical market setup. But anyway, we had the two sort of standard types of market imperfections. I'll talk about each of these. Asymmetric information between borrowers and brokers, between aggregators of loans and rating agencies, and between investors and issuers. And all of these things caused problems. And then agency problems from both borrowers and brokers and investors and rating agencies. Improving the competitiveness of the mortgage finance market may have resulted in excessive rent taking. Is what you had is just everybody could open up a mortgage company if they wanted to. There's a sign I wanted to take a picture of, and the place went out of business before I got around to it. But in Bethesda, there was a place that offered laundry, massages, and mortgages. That was on the sign of this particular business. You know, if you're in a position like this, there's sort of if you're a broker, well, if you lose out, doesn't matter. I mean, you've lost. But if you're a winner, you can make a lot of money. Okay, and this encourages excessive risk taking and rent taking. So, one of the interesting things, though, that is not clear is, did this behavior actually lead to an increase in the home ownership rate? The home ownership rate went up a lot. It's come back down again some, but not all the way back down to where it was before this whole thing started. And so if there is something good that may have come out of this, to the extent you think home ownership is good, I think we need to keep that in mind. Okay, so agencies and their incentives. Okay, start with borrowers. Borrowers have, and this is work that Yang Heng has done with John Quigley and Bob Van Order, looking at heterogeneity of borrower behavior. Borrowers have measurable characteristics and they have unmeasurable characteristics. Okay, basically, the measured characteristics are three that matter. Their FICO score, okay, and FICO is a pretty good predictor of how well people pay their bills. Past performance does tend to predict future results. Loan-to-value ratio, how much equity people have in their house, and payment-to-income ratio. Okay, those are three measurable things. The first thing we measure sort of exogenously. There are these firms out there that do it, and you know, you see these things online, basically game your FICO score. But you know what? Lenders actually observe that kind of behavior, and it gets put into the information set. Loan-to-value ratio, there's a way that it is not gameable, and there's a way that it is gameable. How is it not gameable? Well, if people come forward with a down payment from their own funds, that's not gameable, right? If you actually write a check for $100,000 and you can demonstrate that it is your $100,000, that you've had it in the stock market or had it in a savings account or something like that for the last 6 months, that's not gaming, right? But the flip side is the appraisal of the house. That's something that can be gamed. And so you look at things like cash out refinances, there is opportunity for gaming, and we saw evidence of lenders doing things like saying a house was worth more than the loan, and therefore, even though it's not what people paid for the house, that there was equity in the house when the equity never really existed. So real equity, you know, paid in equity is a very powerful predictor of loan performance. And if it is measured in a certain way, it is actually measurable. Payment to income ratios surprisingly have a very poor history of predicting default behavior. Okay, and the reason that is because it is almost always mismeasured. And so what you get is an errors and variables problem. Is if you have a mismeasured right-hand side variable trying to explain something, right, the standard error of it gets large, it's biased downward, okay? And the right-hand side variable of payment to income is often mismeasured for a variety of reasons. The most important of which is if you know you're going to get the loan, you don't have an incentive to report all of your income, to document all of your income. So observed payment to income ratios are often higher than actual payment to income ratios. So the example I give is my wife as a physician gets paid a salary and then gets paid productivity. Okay, the salary is actually kind of a small share of her income. It's like half of her income is salary and half of it comes based on the number of patients she sees in a year, basically. Okay, her salary and my salary together are sufficient for us to get the mortgage we want. okay? And so the salary comes on a W-2, it's documentable, it's easy. You know, why bother going through the hassle of getting all your tax returns to show this extra income? So our measured payment to income ratio is higher than our actual payment to income ratio, okay? Now put this in a regression, and what you get is a bias coefficient on payment to income ratio as a predictor of default. So payment to income, we are almost sure that it matters, but we don't measure it particularly well. Okay, so there are certain classes of borrowers that are sufficiently homogeneous that we don't need to worry about them. So if you're looking at the group of borrowers who have 800 FICO scores, 30% down, where they're writing a check, and payment to income ratios of 15%. Okay, well, whether it's 15 or 17 or 10 doesn't really matter very much. Those people are going to pay their mortgage back. They're going to pay their mortgage back more than 99% of the time under every kind of market condition we've observed going back 40 to 50 years. So you can have, there are these borrowers that are pretty homogeneous from the standpoint of credit risk. So if you pull them together into mortgage-backed securities and treat them all the same, it's fine. Okay, you really have a commodity product there. When you get outside of that data, however, that support, into borrowers who are more marginal, the nature of their marginality is very difficult to measure and is very widespread. Okay? So there's a lot of unobserved things about people. So think about this. If you are a borrower and you have a 750 FICO score, which is a very good FICO score, and you choose to get what's called an AllDay, which is a low documentation loan, or a subprime loan, what does that likely say about you, about your unobserved characteristics as a borrower? Yeah, your unobserved characteristics are riskier than people who don't want to be in that market. Okay. Now this is something that lenders should have figured out, but they didn't. Okay, I'm going to show you a picture in a bit that demonstrates this.
They didn't want to find out?
Yeah, no, I think, and that's going to be the set of incentives through the chain, right? Is people, basically it's, there was an attitude, nothing to see here, folks, let's just do our deal and then move it along to the next person in the chain.
So their ignorance was willful in the sense that the obvious conclusion they probably could have had, but this justified what they wanted to do anyway.
I used to think the ignorance was willful, but something pretty... I learned about compensation structure at Countrywide and the sorts of people they hired. Okay, Countrywide's a company that 6 years ago, all their loan officers were on salary. They moved to, Angela Mozilla moved them all to commission about 6 years ago. Okay, so that was the first flag. The second thing is, if you talk to people who were loan officers hired by Countrywide, these were not people with college degrees. These are people with high school diplomas. And while there's nothing wrong with people with high school diplomas, it means that there's probably a certain level of sophistication they are lacking. What they were basically given were scripts in order to encourage people to take on certain kinds of loans, okay, that generated high fees. So sort of the retail face of this business, there was ignorance, but I'm not sure it was willful. The people hiring were willfully ignorant, but sort of the broker who was the interface, I'm not sure they were sufficiently sophisticated to be willfully ignorant. I've talked to people about how they went about business, and basically they strongly encouraged borrowers to get mortgages that generated the most fees for Countrywide. And Fannie Freddie mortgages don't generate much in the way of fees, because Fannie Freddie, being in a monopoly position, could basically tell lenders what the fees they were going to get for originating a loan for Fannie and Freddie. So I suspect, and this is going to be something that's worth studying, that there were lots of borrowers who would have qualified for a Fannie Freddie loan who were pushed into a subprime loan.
That's what I'm going to ask you, Richard. With the concomitant expansion of home ownership, there are a whole bunch of people who never engaged in mortgage behavior before.
Right.
And so there's just simple mistakes that get made. Right? I mean, if your parents have never bought a home, you've never done it before, you don't have any idea what the difference differences between these mortgage instruments are, and all of a sudden you're dealing with somebody who's advising you in certain directions.
Well, and in particular, so I'm going to skip ahead a little bit to a point. One of the things is, even for sophisticated borrowers, mortgage disclosure is a very difficult thing to do. It's it was sort of a parlor trick, but I liked it. As I was at a conference at Harvard Business School about a year ago, and this Harvard law professor says, how many of you in this room have a adjustable rate mortgage? And sophisticated borrowers at the time would have adjustable rate mortgages. So about half the people in the room stood up. And these were, by the way, these were Harvard and Yale and Princeton and Stanford professor types. This law professor says, okay, for those of you who know whether your rate is tied to treasuries or LIBOR, remain standing. Half the people sat down. Okay. For those of you who know what the margin is on your index, remain standing. Okay, another half of the people. Well, he got to three very basic questions about their loans, and there was only one person remaining standing in the entire room. And the person sitting next to me whispered, well, that guy will never admit he doesn't know something anyway. So they didn't even believe him. But you get the point. It is, from the standpoint of borrowers. By the way, I'm not going to let borrowers entirely off the hook. I'm going to talk. There were bad borrowers out there too. But if you have a group of Harvard and Yale professors who really don't understand their mortgages in some very basic ways, to expect someone with a high school diploma to understand a mortgage is asking too much of people. Okay, and so this is, the evolution of my thinking on so many things has changed in the last 18 months. I was one of these 2 years ago, caveat emptor kind of guys. If you were dumb enough to get the mortgage, it's your own problem. But if you start thinking about what you're asking, the information you're asking people to process, I don't think you can take that view anymore. Now, how you regulate it is a tough issue, and we'll come to that a bit. Yeah. Was there a comment?
So how does this issue versus willful ignorance versus some more basic form of ignorance work as you go up the chain toward the people putting together the CDOs, the investment bankers, the head of Lehman Brothers?
Right. I'm going to talk about CDOs at some length. I think what happened with, so I've been teaching CDOs for 4 or 5 years. And so again, since I said I got all kinds of stuff wrong, I'll tell you something I got right, but then I'm going to let the originators of CDOs off the hook. So just to get ahead, anybody not know what a CDO is? Okay, it's all right. It's a derivative of a derivative. So you basically, if you take mortgages, you chop them up into what are called collateralized mortgage obligations. Okay, and that structure makes all kinds of sense. So you have a senior piece and you have a subordinated piece. The senior piece gets the first mortgage payments, the first principal payments. When that principal is retired to the senior piece, the subordinated piece starts getting principal payments. The sub piece gets interest all along with the senior piece. But if mortgages fail, it's the subordinated piece that takes the hit. Okay, this is well understood, right? And we had a CMO market going back to the early 1980s, and it actually operated quite well. And it makes a lot of sense to let people sort themselves, investors sort themselves into risk characteristics and be rewarded or not rewarded based on the amount of risk that they want to pay. And that's why, again, I suspect when this market comes back, we'll see the CMO structure return. The CDO structure is sort of a CMO squared. Okay, so the idea is you take that subordinated piece and you put them together with other subordinated pieces. And because of that, from a law of large numbers perspective, you get precision on the probability of losses, right? You know there are going to be losses on that piece, but because you put them all together, you get rid of the unsystematic risk, basically. And so, if your sampling distribution is the same every time, and you have 1,000 of these guys, and the losses is always 10%, then you know with certainty the losses are going to be 10%. And so the idea was then you chopped up that piece based on that 10% loss probability. I just made that number up. So you have a 70% senior piece. You say, we have so much knowledge about the loss properties of the subordinated piece that we can rate this top 70% of it AAA. Okay? So that was the idea. I don't think people were being malicious when they were doing that. I think people fell in love with technology when they were doing that. I think people got very excited about the financial engineering. And the reason I say that is I know some people who did this. And I don't think there was any willful ignorance or intent to deceive. I thought they thought they were so clever that they could kind of overcome bad underwriting through financial engineering. And so what that is more intellectual hubris than it is dastardly behavior. But it just shows that that can be just as dangerous. Yeah.
And how much of this was just completely premised on an underlying assumption that they could sample this with independence and that they would?
Well, of course that was the underlying assumption. And of course they didn't think carefully enough about that. And that's one of the things I'm going to come back to is, if you starting, let me put that off because I'm going to get to all of that. But yeah, the idea of sampling with independence was, I think, one of the intellectual flaws and underpinnings of this whole crisis. But these were, these guys on Wall Street, they were engineers. They weren't. I don't think the worker bees were trying to screw anybody, and I think their bosses didn't really understand the product that they were putting out on the street. They just saw it as a way to make money. Which is different from, you look at a Countrywide, and they're the bosses. What they were doing was just bad. They were willfully taking on risks and trying to pass it along to somebody else and making a lot of money in the process. Where the Wall Street guys, the Wall Street executives, what they did that was bad was the way they levered up on this stuff. And even if they didn't understand the CDO product, they should have understood well enough that they were doing something sufficiently new and uncertain that they shouldn't have been levering like crazy in order to fund this stuff. That I'll say. But I think, think about the students you have. How many of them really understand the implications of sampling independence? Or the MBAs over at Marshall, as good as they are? My guess is they don't really internalize that stuff particularly well.
No.
And so,
No.
again, it shows that actually knowing stuff matters. Hallmark of the new administration. All right, so we have borrowers are heterogeneous, and there's unobserved stuff about them, and we should have figured out that the unobserved bad borrowers were the ones that were more likely to step up and take these mortgages. Brokers were trying to extract rent in the ways that I was describing. Subprime originators and private label MBS issuers, there was sort of this race to the bottom in credit policies. Getting the deal done was more important than anything else, and so, okay, you tell me you make $100,000 a year? Sure, whatever, I believe you. Regulatory arbitrage. This is something that I thought was a lot more important 3 or 4 months ago. Again, you changed your mind. My story used to be, until 3 or 4 months ago, well, if you look at the unregulated lenders, they were fundamentally different from the regulated lenders. A regulated lender being somebody like a federally chartered bank that has to have capital requirements and so on. And it was the private label guys, it was the securitized guy, it was the investment bank driven stuff that all turned into piles of manure. But now the stuff that the banks were doing is starting to look just as bad. So that's actually screwing up my hypothesis about regulatory arbitrage. And ratings arbitrage. So there was an issue that a AAA is a AAA is a AAA. Okay? So if you're a fiduciary and something is rated AAA and has a higher yield than something else, what are you going to be tempted to do? You're going to invest in the higher yield AAA security, but what should it tell you about that security if it gets a higher yield? It should tell you it's a higher risk security, right? But people, again, there's a sort of regulatory arbitrage. If you're a pension fund, you're allowed to invest in securities that are, I think BBB plus is sort of the lowest you're allowed to go. So what are you going to do as a manager of a pension fund where your compensation is tied to returns? You're going to take the BBB plus stuff that has the highest return, okay, within that category. Well, it should have said something to all of us about Moody's and Standard & Poor's, that you got pretty wide ranges in yields on identically rated securities. And then investors, this is the puzzle, is why wasn't the due diligence on the part of these are the guys who ultimately took it in the end. And early on in the crisis, one of the things that annoyed me is advocates were complaining about how evil lenders were. And I was thinking, and by lenders they meant the funders, and I was thinking, but they've lost all the money. So how evil could they have been? And so it is a bit of a mystery how we had so many investors make so many bad decisions. That everything else in the chain is explainable. Sort of the decisions on the part of very sophisticated people like Bob Rubin to make the decisions that they made, I think, remains something of a mystery. Okay, so borrowers. We've really talked about this. Households face, mortgages are complicated. They have embedded options in them, a call and a put, and if they have a prepayment penalty, that makes them different. Households can be exploited by the mortgage finance system. Again, this is a point of view that has evolved for me. One of the things is usually, if you look at the behavioral finance literature, about 40% of borrowers focus on only one thing when they're making a borrowing decision. And that one thing is, what is the first monthly payment? They don't even care, 12 months from now, they don't care. And even if they did, right now we have a real problem, is if you look at APRs on adjustable rate mortgages, they're actually lower than the initial coupon rate. And the reason for that is because one-year Treasury rates are so low at the moment that that rate plus the margin creates a lower rate than the rate they're paying right now. So if you get a one-year ARM right now, you're paying about 4.5%, okay? And if you're at one-year Treasury plus a 225 basis point margin, which would be typical, you'd be at 3.25%. So the disclosure on an ARM right now requires you to disclose your first payment and then the first adjusted payment, okay? And then the assumption is that payment goes on forever. So if you're a borrower, and even if you care about the payment in 13 months, you're going to say, oh, well, right now it's $1,246, but in 12 months it goes down to $1,000. So it's even better, okay? Well, that's not that doesn't disclose the fact that, of course, rates could go up a lot between now and then, and rates could go up. So the myopic focus on payments is a problem. But the other thing is there were clearly households that exploited the system. So this worked in the opposite direction. Of the subprime loans originated in 2006, 6% of them never had a single payment made on them. Not one. Okay. So 6% of mortgages, the borrower took the money, didn't make a single payment. Well, what was that all about? Well, it was speculators. Going to get a loan to buy a condo in Las Vegas with no money down, and I'll take delivery of the condo, and then I'm going to check to see if the price has gone up or down. If it goes down, I'm going to walk away, and if it goes up, I'll sell the condo and make a killing on it. Okay, well, that was about the time when prices in Las Vegas started to crater. And so none of these borrowers who were borrowing for the purpose of speculating in the Las Vegas condo market made any payments on their loan. And we had things like fraudulent employment verification. The entrepreneurial spirit of the American people is a really wonderful thing. There was a firm that went online. If you went online, there was a firm called verifyemployment.net. And they would certify that they hired you as a consultant at whatever rate you wanted to do. And then they would say to the lender, okay, this guy's making income, and okay, that checks that box, and we're off to the races. And then you have the AllDay customers. Typically, an AllDay customer was someone with a high FICO score who didn't want to reveal anything about him or herself. Why do they do this? Well, maybe they're using income from a household member with bad credit. Maybe they can't qualify under standard ratios. Maybe they're self-employed and have not filed a tax return. Or just they have significant income not reported to the IRS. And there was a story in Inside Alternative Mortgages that documented that this went on fairly often. Well, again, if you have any one of these characteristics in your 750 FICO borrower, you're different from the typical 750 FICO borrower. And those borrowers are going to self-select into these kinds of mortgages. So here is, a view. A lot of people were enthusiastic about the subprime market. This is as recently as 2005. And again, I had some enthusiasm for the subprime market. I thought Martin Iquez, who runs, he's the guy in North Carolina who's gotten a lot of the anti-predatory lending laws done, and I'm forgetting the name of his organization now, but I thought what he was basically doing was keeping poor people from getting credit. And it was one of these, I was one of these guys who said, well, it's better that they get a subprime mortgage than they get a payday loan, or they get go to a pawn shop or something like that. So I think the economics profession was largely behind the idea of subprime mortgages. But there are two issues here. Is how many first-time homeowners were served by the subprime market? We really don't know yet. The data is very thorny on this stuff. And the other thing is, if you're in trouble and you own a house, was it really better, again, to go to a credit card or a payday loan, or to get a subprime loan if you need equity in the short run? But again, we don't have good evidence on the extent to which that happened. So one of the things that was interesting in the subprime market is it did tend to, more and more of these loans were in fact used to buy houses. So initially, if you look at the beginning of the subprime market in the late 90s, less than 30% of those loans were used to buy a house. Most of them were used to refinance or to extract equity. As you got further along, you had people buying houses, about half. But again, we interpreted this at the time as evidence that subprime mortgages were allowing people to be homeowners, when maybe what they were doing was allowing people to be speculators. Okay. We looked at investor loans. These are data that come from loan performance. We were trying to find the extent to which investor loans as a share of total purchase origination was part of the story. And one of the things that was interesting is sort of on the uptick, we didn't find a whole lot going on. And we think that reflected mismeasurement. But the downside, you see pretty substantial drops in investor loans. For example, in Phoenix, once house prices started to fall, 8% there, in Las Vegas, 6% there. But we were hoping to tell a big story about the importance of investor loans, and again, part of it is the data are very bad. We do note that if you look at low-doc loans, they were used more often both for investor property and for second homes than they were used for owner-occupied property. These are as a share of all non-Fannie Freddie loans. And they did use 228 loans. Again, our expectation was you would see them largely in investor property, but they seem to be used in owner-occupied as well, which probably revealed that people were not telling the truth about how they were using their house. Now, the 228 loan was, I was going to say that the 228 loan seemed to be a loan that was designed for investor housing. So the 228 loan worked like this: is you got a teaser rate for 2 years. The rate would reset after 2 years at a very high rate. These loans came with a prepayment penalty, which is to say if you wanted to refinance before the rate reset, you would have to pay a substantial prepayment penalty. This would seem to be a good loan if you're an investor, because the deal is you have a subsidized rate for a couple of years. You can invest, see if things work out. If they don't, you walk away. If they do, it's worth paying the prepayment penalty and refinancing. So our suspicion was that you would see a lot of investor loans, a lot of 228B investor loans, but we really couldn't differentiate. But again, our suspicion is it's because people lied about whether they were investor loans or not. Now this is the thing, something else that surprised me. If you look at the percentage of 100% LTV loans, 100% plus, you can see they largely went to people who were becoming homeowners. So 20% of the subprime market, owner-occupied subprime loans that were originated in 2006 had 100% LTVs or higher. Now again, how 100% LTV loans were ever done is sort of amazing. But I think the story was something like this. First of all, by the way, we should have known that 100% LTV loans were a bad idea, because if you look at the default performance of VA loans in the 50s, it was bad. And if you looked at the default rate of the HUD Section 235 program in the 70s, it was bad. So we'd run the movie before. We tried letting people buy houses with essentially no equity. They default in large numbers. But I think what was going on here is between 1996 and 2005, house prices in the United States rose everywhere. And because they rose everywhere, we didn't observe losses on any kind of mortgages, because people always had an incentive to sell their house rather than default. And so there was a sense that all real estate loans were safe, even 100% loans, because the value of housing would go up forever. Again, people should have known that at some point, somewhere, house prices would fall. I don't think anybody expected, certainly I didn't, that house prices would fall everywhere, which is what's happening. But it would happen somewhere, and all it needed to do was happen somewhere to get large amounts of default. The other interesting thing about the subprime market is if you look at the share of borrowers, and this is the steering story and maybe the investor story, the percentage of subprime borrowers who had low FICO scores dropped dramatically. Okay, so 620 is sort of the magic point at which loans don't get securitized in prime pools. And if you look what happened to the share with those FICO scores, it dropped. Okay. And so you say to yourself, well, does this mean that the quality of these loans was getting better? And I think the answer is no. I think this comes to this borrower heterogeneity issue. There's a paper by a guy named Ben Keyes, who's a PhD student at Michigan, who we're going to have here because he's interested in working here. I hope he's interested in working here anyway. We did a very clever strategy. He looked at borrowers with FICO scores of 621 and borrowers with FICO scores of 619. And he looked at their performance across time. Okay, a 621 score you can securitize. A 619 score you can't securitize. So basically, if you're a bank and you lend at a 619, you got to keep the loan for yourself. If you're 621, you can dump it onto someone else. Okay? Default performance among the 621s was much worse than it was among the 619s. Okay? Now, they're the same from a FICO standpoint. They're the same, right? It's just 620 just happens to be an arbitrary institutional cutoff. There's not a material difference between a 619 borrower and a 621 borrower. Yeah, yeah. So,
in other words, if they had to keep it, they were actually much more prudent.
If they had to keep it, they were much more prudent. Well, we have evidence consistent with them. We want to be a little careful. But yeah, they default a lot less often if they keep them than if they don't. Okay, what about brokers? Well, we already talked about this. The big thing, I think, is bullet point 3. Brokers face limited consequences from originating inappropriate or fraudulent loans. The market for broker originations, was extremely competitive. What a broker would do is fax applications to multiple lenders. 73% of brokers shopped identical AllDay and subprime loan packages for pre-qualification to 2 or more lenders, and they were trying to get the best deal that they could, which basically meant get the most fees that they could. And so you have this phenomenon where brokers really are in a position to extract fees from both lenders and not give the best terms to borrowers. And one of the interesting things we're going to look at in a second is what does this mean about differences in the retail and the broker channels. So again, to explain, when a retail channel, that means that the lender is at least keeping the loan for a little while. Okay, where a broker channel, basically, you don't even touch the loan. You just get fees if the loan gets done. All right? So basically, the retail channel is going to be at a comparative advantage with a Fannie Freddie kind of loan because they have, one of the things Fannie Freddie treats large lenders better than others because they want the business. And so the fees are lower that Fannie and Freddie charge for guaranteeing loans. And so you would expect the retail channel to have more prime loans and the broker channels to have fewer. Okay, well, if you look at the share of no low doc loans by the channel, you can see across from 2003 to 2006, this is again loan performance data, brokers are substantially more likely to originate low doc loans than retail bankers are. And if you look at hybrids, then the difference is not quite so large, but brokers, so 228 is a hybrid, brokers are more likely to originate hybrids than the retailers. If you look at those with prepayment penalties, again, the brokers were more likely to originate loans with prepayment penalties than the retail bankers. And brokers were more likely to offer hybrids to borrowers with FICOs in excess of 660 than the retailers were. So sort of every dimension in which a loan could be more controversial, higher risk, we do observe that in every year, brokers were more likely to originate that kind of loans than retailers were. The thing about retailers, very often they take the loan and then they'll sell them again. So it's not like they keep them forever, but they do at least have to touch them for a while. Whereas the broker never actually touches the mortgage. These numbers are so small, it's not, again, probably not worth it. Okay. Originators. Okay, originators, again, are the difference between a broker and originator. Originator has money, a broker doesn't. Correspondent lenders basically acted as super mortgage brokers with warehouse lines and made a decision about whether to sell loans to their correspondent bank or to the wholesale broker. When liability was a concern, again, when the loan was inferior, they would sell it as a broker. When they liked the loan better, they would basically sell it to their corresponding institution. What they found is that when they tried to originate high credit standards, they would lose business and would worry about survival. And one of the really interesting cultural phenomena that I think needs to be studied is the Wells Fargo phenomenon. Because Wells Fargo refused to get into this business. And in fact, Wells Fargo refused to get into all kinds of lower quality business. They lost a lot of deals in a lot of dimension. And shareholders can be unhappy with senior management if it does this sort of thing. And so how Wells Fargo senior management managed to keep shareholders happy while having the gumption to say no is a phenomenon I think I'd like to understand a lot better. And if we could bottle it and replicate it, it would be a really good thing. And of course, they're sitting pretty, right? Or at least we think we are, though, every day. You know, Bank of America 2 weeks ago, I would have told you was in good shape. So what do I know? But you look at, but Wells Fargo did, well, it did absorb Wachovia. So, you know, who knows? Maybe Wells is going to be in trouble now, too. But you look at the culture of the place and how they made decisions. It was fundamentally different from a whole variety of other financial institutions. And why that happened, I think, would be interesting to discover. Yeah.
It seems that the brokers had an incentive to do what they really did, basically make money, right? They're
Yep.
working on commission.
Yep.
My question is, who was doing the due diligence on the retailer, side?
Well, the originator, and to some extent, so what the originators were doing was if the loan was good, they would send it to their home institution, right? So again, if you're Wells Fargo Capital, you actually send, well, Wells didn't do it, so I shouldn't say that. Your Citibank Capital, you actually send it to Citibank if you think it's a good loan. But if you think it's a crappy loan, you send it off to investors.
Is there any data on denials? As in, people applied and then they were denied loans, which shows.
There is, but it's bad data. So the only data we have, the only comprehensive data that we have on loan applications is the HMDA data, Home Mortgage Disclosure Act data. So the loan performance data, we have information on loans that actually were originated. The HMDA data, it's on all loan applications, but the problem is the data that you're allowed to observe is very limited. The data that they collect are very limited. So HMDA does not have FICO in it, which is one of the most important things to determine whether you get a mortgage or not. But what we do know is that loan application acceptances rose dramatically over the course of the decade from 99 to about 2005. And we now know loan rejections have increased rapidly over the last 2 years. But I think people fell asleep because, again, it's this point, because house prices were going up everywhere. There were no consequences to bad loan decisions for a long time. And so it was kind of like, I have a slide. I'm running out of time, so I'm not going to get through all my slides. But, if you remember the Orange County financial crisis in 1993, okay, well, what that was about is interest rates fell every year between 84 and 1993. So you couldn't make a bad bond bet. Try saying that fast 3 times. And so what happened was the treasurer of Orange County, Robert Citron, started levering up to buy bonds, basically. So he had very long duration with short on his assets with short duration on his liabilities. So in other words, he had these long-term assets with fixed rates, and he had liabilities that he had to roll over, right? Orange County would borrow, I think, in 2-year increments in order to fund 10-year instruments. Well, what happened is there was a pop in interest rates in 93. So Orange County was sitting on these treasuries that were paying 5%, and suddenly their cost of borrowing was 7%. And that didn't work anymore, okay? Well, you look back and you think you have to be a moron to make that decision. But that particular moron had senior people from Merrill Lynch telling him this was the right thing to do. And it's because year after year after year, it made the county a lot of money. They didn't have to raise taxes, and they could spend money on schools, and everybody's a hero. There's a point always at which the music stops. And I think that's what's happened. A lot of what happened here is between 96 and 2005, basically default costs were non-existent. Fannie and Freddie's default losses were less than a basis point, less than 1/100% for every year between 2000 and 2004. That's 'cause people were in trouble, they sold the house. So I think people fell asleep and thought they didn't have to maintain credit standards, and that's why the due diligence went away. Somebody once said, I think something very insightful, I wish who said this to me, but he says, banks are the best backward-looking institution you will ever see. Now look at what happened last month, and that's what they think will happen next month. They never. It's why when we've had financial crises, the way out of them has never been through banks. It's always been through private equity, either public or private. Well, I should say equity, either publicly traded, which is what happened in the early '90s, or private equity, which is I think what's going to get us out of this crisis. But that said, there's a difference. The regulated institutions are doing badly, but if you look, regulated institutions, so these are FDIC-insured institutions, originate a lower share of low doc loans and a lower share of 2-year hybrid loans than regulated institutions do. Okay. Next problem, servicers. Okay, you have a loan that goes into default. It's taken over by a servicer. It's not really in the servicer's best interest to try to fix the problem. Because while the loan is in default, they're collecting money for servicing the loan. Lenders have an incentive to try to keep the loan alive because once they've written it down, they've really written it down. And borrowers, of course, have an incentive to extract free rent if they're in default. So nobody wants default to happen, even when it might be the efficient thing to do. Right? Sometimes just getting the default done, getting the loan cleanly off your balance sheet is the best thing that can do. And so what we see is delinquent subprime loans, because they hang on for so long, they are more than twice as likely to reach real estate owned, which means the lender ultimately owns them, than FHA mortgages. And FHA mortgages are mortgages for people with credit impairment. And it takes about 4 times longer for loans, REO, subprime loans to get to REO than FHA loans, which means the house is sitting around not being maintained and creating greater, perhaps negative externalities for the neighborhood than it otherwise would. Okay, rating agencies. What were the incentives for rating agencies? Rating agencies are paid by the issuers of the securities that they are rating. If an issuer doesn't like their rating, they can just say, okay, I'm going to go unrated and not pay the agency. That is an option. I mean, it is a problem. If it's unrated, then people can't invest in it. And it is striking, if you look at the 2 rating agencies relative to the market. S&P has a whole line of businesses, so rating is only a small part of it. You can see they sort of went along with the market. But Moody's, you saw this big uptick in the value of the company, and that's because they generated a lot of business as these securities started to take off. So they had an incentive to generate business, right? If they started to refuse to rate pieces of paper at the rate that they wanted, they would lose business. Their shareholders wouldn't like it. The other thing is sometimes employees are potential hires for the issuers of MBS. If you're working at Moody's, what you really want to be doing is working at Lehman Brothers, or that you thought at the time, okay, which again sort of screws up the incentives. But the other side, again, is it wasn't necessarily that they were being nefarious. It could be just that they were incompetent. They really didn't understand the risk involved in these mortgages. Although, interestingly, there were advocates. Engel and McCoy are borrower advocates, and they complained that Moody's rated subprime mortgages too harshly and therefore made the cost of borrowing higher than it needed to be. But the rating agencies in earlier subprime mortgages excluded important risk factors. The rating agency model of CDO risk was shown to be inadequate with GM and Ford. So we knew that the sort of independence assumption that was driving thoughts about the precision of the estimates was not correct. So they just screwed up in all kinds of ways. The issue with them is whether it was nefariousness or incompetence. I tend to lean toward incompetence. It does make you wonder about the evolution of this market. So you think about where we were before subprime came along. And we had a ration mortgage market. So basically, either you were in or you were out. And so from a welfare standpoint, it makes sense to say, well, what if we priced some of this stuff? And we let more people in exchange for them paying more than they otherwise would. That sounds like a social welfare enhancing thing to do. But you have to have a model of default risk, and you're relying in this case on rating agency models. Well, where's all your data coming from before the existence of a subprime market? It's coming from the prime market. Can you draw inferences about subprime behavior based on a sample of prime borrowers? No. Okay, so what would have been the right thing to do if you wanted to do this? You would have done it slowly, right? You would have started with a sample of 10,000 mortgages, which, if they go bad, it's not good, but the economy is not going to collapse if you try something out with 10,000 mortgages and it doesn't work. And you start developing models based on the characteristics of those mortgages. But you will let this evolve. And it's sort of like medicine, right? The frustrating thing about medicine is you can't know the epidemiology of something until you wait for a long time. You try out a certain drug, you don't know in 6 months if it's going to work. You don't even know in 3 years what the side effects are. You might have to look 5, 10 years in the future to really know the implications of this. Well, similarly with the mortgage market, perhaps had we done experiments and run them out over at least a 5-year horizon, we could have avoided some of the issues, some of the modeling issues that we faced, but we didn't. Rating of structured finance tranches, again, this is something that I've sort of alluded to when I talked about CDOs, is the performance of these tranches depends crucially on whether you get the default probability, loss probabilities correct. And if you get it off by a little bit, you sort of fall off a cliff in terms of, it's not just like a regular corporate bond where you have sort of continuous changes in prices based on changing interest rate and credit conditions. Sort of once you're over the dam, you're over the dam. Once you start taking losses, you start taking losses, and you substantially erode the position of the security. Now again, we had some history on this. In the commercial mortgage-backed security market in the early 90s, manufacturing, asset-backed security market in the mid-90s, and the residential mortgage-backed security subprime sector starting as early as 2002, we were starting to see some failures in the structured transactions. We should have known that there were issues here and that we didn't know as much as we thought we did at the time. Okay. One of the things, though, is if there were generic incentive problems for rating agencies, why do we see downgrades only in one sector? So this is kind of interesting. If you look at all ratings, okay, from Moody's, if you look at the prime jumbo market, there was as much a likelihood of upgrading as downgrading. If you look at AllDay, again, more upgrades than downgrades. But if you look at subprimes, lots more downgrades than upgrades. So if there was a generic problem of incorrect rating in response to business incentives, you'd expect more constancy across class, right? You'd think they would get it all wrong. They'd downgrade them all wrong. But there was something particular about subprime, right? The jumbo business still made the rating agency money. And yet, the rating agencies, what that says is they were too conservative when they initially rated them. So this is the one bit of evidence that maybe it wasn't malfeasance, but rather incompetence that led to the screw up in the ratings. Okay, well, what about investors? Well, I've already alluded to this. Lulled to sleep. Incentives. I think one of the things going forward that the next administration is going to have to deal with is just the general issue of compensation. Fund manager compensation is a real problem. The typical model was the 220 model. And the way that works is a fund manager gets 2% of the value of the portfolio he or she is managing plus 20% of any excess over an index. So if you do better than the Standard & Poor's, say, you get 20% of that better. If you do worse, it doesn't matter if you do a little worse or a lot worse. It's that 2% you still get. So you have this asymmetric set of incentives that leads to excessive risk-taking. Liquidity premium, as the sort of ratings agency arbitrage is if you have a AAA rating on something, then you're more likely to, then you're allowed to invest in something. So you're going to pick the AAA thing that has the highest return on it. Yeah, was there? What? Oh, okay. Transparency, again, the CDOs, I just explained how they worked. I'm not sure that the average investor of a teacher's pension fund board member would have gotten that explanation. I'm not sure if you put an English professor in a class for a month that she would get it. I say that because my mother was an English, she's retired now, but she was an English professor. She's a very smart woman, very wise woman, taught me a lot. You know, I think the world of my mother, but when it comes to you put a number up, she just freaks, basically. Other than doing, she can do balance her checking account. That's about as far as she can get. So, you know, she's the sort of person, she was actually a leader in her faculty. You could see someone like her being on a pension fund's board. She's not going to know what these things about. Yeah?
Even we are smart enough, would there be the CDO document available for the public to access?
I beg your pardon?
Even though we understand the CDO's structure, so with that document, how the CDO's construction is available for the public to access?
No. So, yeah, we don't, and actually one of the things that's so terrifying about this crisis is what the Lehman Brothers thing taught us is the most fundamental thing about these derivative securities. We don't even know always how to identify the mortgage that's supposed to be, whose cash flow is supposed to be coming in. Yeah. Yeah, so That's a very good point. Even if you understand conceptually what these things are, actually being able to look at one of these things and try to figure out where the cash flows are coming from is difficult. And then just, poor judgment and taking a risk position on U.S. house prices. One of the things that might have explained what went on is if you look at the amount of liquidity that's swimming around the world, that this liquidity was looking for a home. So this green line is the supply of agency and treasury securities. So these are Fannie and Freddie Mac mortgage-backed securities and bonds and treasuries. And this is through 2007. I'm suspecting the amount of treasuries available is considerably larger than it is right now. But this is new treasury issuance, and this is the amount of federal central bank assets from central banks around the world. Okay? And so what you had was this excess supply of money on the part of foreign central banks, Chinese central bank, Japanese central bank, and so on. They were looking for places to park their money. And that's probably one of the things that drove spreads to be so ridiculously low for a while and so on. Okay, so some policy options. Okay, what kind of triage would be appropriate for the wave of defaults? Well, again, here is a place where I have completely changed my mind. It's a year ago, maybe 18, I don't remember exactly when I changed my mind, but I thought the moral hazard problem of having mass modification of mortgages was so severe that we shouldn't do it. So the idea is if you're a borrower and you got yourself into a mortgage that you shouldn't, and now we bail you out, then you're going to learn a lesson, which is, well, you can make stupid mistakes and you're going to get bailed out. The same on the side of I remember when the Bear Stearns bailout happened, I was appalled that the shareholders were left with anything. I thought they should have been wiped out. Actually, I still think they should have been wiped out. But the only way the deal was going to get done was for them to get $10 a share or whatever it was. Well, the moral hazard ship sailed a long time ago for the following reason is, imagine someone who buys a house in a floodplain, okay? And a flood comes along and they're wiped out. What is the right policy response? Okay, it's in an identified floodplain. They haven't bought flood insurance. They get wiped out. What is the correct policy response? It's sorry. Okay. The federal government has drawn a map that says you're in a floodplain. The federal government has offered you insurance. You have spurned it. So why are we responsible for this stupidity? But in 1993, it rained in the Midwest for something like 7 weeks solid, and there was a 6th Great Lake over Iowa. The satellite photos were amazing. Hundreds of thousands of people's houses were underwater. People whose houses were not in anything like a floodplain. What do you do with those people? Do you say sorry to those people? Was there a moral hazard problem there? I think you help those people out because no amount of information could have told them that this was coming. They didn't do something that brought it upon themselves. And that's where we are right now, is the size of the default, the magnitude of defaults is so large that it is influencing surrounding house values. Okay, we're seeing that particularly in the San Bernardinos and Riversides and Mendocino counties of the world. We had a speaker in last fall, Ingrid Ellen, who did a very nice paper sort of separating out the supply and demand effect of default. Okay, you have this problem. If you have default, is it because the market has dropped, or is it that the defaults are causing the drop? And I think she did a nice job of separating them out. And so we need to think about how do we get people out from under this. And I think a policy should have 3 components to it going forward. This is not scholarship. This is just, what's the word, pontificating. People's houses have to be worth more than their loan balance, okay, which means you have to write the loan balance down. People need to be able to afford their payments. And if the housing market comes back, for people who've had their loans modified, they need to pay, there needs to be a clawback. So they pay the money back to the government. I think if you did those three things in a proposal, and I have not seen a proposal yet that does all three of those things, you might be able to get somewhere with getting us out of this mess. Okay, what about brokers? Well, I think we just can't have a world anymore where brokers' compensation is not in any way dependent on loan performance. It needs to be clear what all broker fees are, although again, the problem with mortgage disclosure is every time you add a disclosure, you're adding another piece of paper that people have to sign. And how many people have mortgages? How many of you know what you signed when you got your mortgage? You read every page?
I read everything.
Wow, how long did it take you?
Like a week.
Yeah, wow, I'm impressed. You get the point, right? So you
That is the guy who bought him in his room.
I think, regulation of everybody in the chain. We can't have unregulated institutions, particularly with such large leverage and with large balance sheets. So that means the end of investment banking as we knew it. The key thing is everybody in the chain needs to have money at risk. And that's what we lacked before. It starts with the home buyer. Is homeowners, the thing that impedes people from becoming homeowners more than monthly payment is down payment. And so from a standpoint of, do we want everybody to be homeowners? Well, that's tough because there are people for whom getting a down payment is difficult. I don't know if median net worth among African Americans in the United States is about $100. So, median financial net worth among African Americans is about $100. So getting a down payment is a real issue. It's a real impediment. But we now have a lot of history. When people haven't put their own money at risk in a house, they're a lot more likely to walk away from it. Brokers, their compensation has to be tied to the performance of the loan. They don't get paid until the loan is paid off. I mean, they get paid some, but not all of it. Banks have to have capital. Both commercial banks and investment banks have to have capital at risk. Rating agencies have to have something at risk if they get it wrong, beyond their reputation. And investors just have to be smarter. I mean, in the end, investors just didn't do their due diligence, and that wasn't correct. The final thing on getting back to the borrower and lender relationship, there's a guy named Michael Barr at the University of Michigan. He's a law professor there that has an idea that I really like. And the idea is this. Before you are offered any kind of subprime loan, you must be offered, at whatever the appropriate price is, a 30-year fixed-rate self-amortizing loan with no prepayments. And you must sign a piece of paper saying you have been shown this loan and you have refused it before you're even allowed to look at anything else. So the idea is, this is again framing, there's a default. Sort of like the way we know that when people have money automatically taken out of their paycheck and put into a 401k, they do it. But if they don't have it automatically taken out, they don't do it. If people's default mortgage is the 30-year fixed rate mortgage, and that is the safe mortgage. If you look at what are called non-credit enhanced prime fixed rate mortgages owned by Fannie Mae and Freddie Mac, the default rates on them are still less than 1%. That may be a start in terms of informing borrowers something that they need to know, and so that they'll make better decisions. Because at the end of the day, if borrowers make bad decisions, everything else is going to fall apart. Yeah.
Won't that be by definition a it doesn't kind of jive well because subprime is higher than the conforming mortgage, right?
Well, yeah, it'll be expensive. Right, the interest rate will be higher, but at least you know what your payment is going to be forever. And you can emphasize that that this is your payment forever. So if you want to be absolutely sure what you're going to pay from now, I'm not saying it's a panacea. I'm saying, in the old day, the countrywide model was sort of, no, nothing to see here. Let's move on to this exciting loan where your first payment is going to be lower. So just some conclusions. I mean, what we had here was a social experiment with what happens with pure private markets. Brokers were atomistic competitive firms. You had an unregulated sector doing originations and securitization, private rating agencies protecting investors. So, this was Ronald Reagan's dream of how financial markets are supposed to work. In response, you got predatory lending, predatory borrowing, loans based on securities profitability rather than suitability, and exploitation on both sides of asymmetries of information. We got expected defaults at levels that I think create neighborhood externalities. I see Lisa's skeptical. That's all right. I was again.
I was skeptical until you said callbacks, and then my brow stopped for.
And so, what we need to change incentives and constrain behavior. It means regulation, and I think a lot of the regulation has to be, everybody in the chain has to have money at stake. If they screw up, they lose money. That is an economic incentive that I still believe matters to people. And we actually know, so behavioral economics tells us that people care more about losing money than they care about making money. So you have people's money at risk, they're less likely to go out on that risk limb, and it's their money, than is the alternative. So that's I skipped over some things very lightly, but we're at 1:30, so I'll stop. Yeah.
The one question, first of all, I want to thank you. But I also want to say, what I think is most interesting is, and we didn't have to hear this from our previous speakers, is how much this has caused you to rethink everything. And does that mean that the kinds of theorizing and analysis that you engage in the future will require, in some sense, reconstruction?
Yeah. One of the things I've been hoping to do is sit in on Juan Castillo's class on experimental economics this semester. I've been reading Daniel Kahneman's stuff on framing. I think economics remains a really good point of departure for thinking about things. I think it is important to think. What we've seen here, incentives do matter. If you give people the wrong incentives, they're going to behave in certain ways. And so that's a powerful insight that comes from economics. I think where economics fails us is it thinks that the institutions that are necessary to create the correct incentives are just automatically going to appear. And if anything, what all of this is reflects institutional failures in all kinds of places, on the part of government, on the part of households, and on the part of businesses. And how do you keep institutional failure from happening? It's some sort of government intervention. But I think you need to think about the intervention the right kind of way. So if you remember, when I come back to the kind of intervention I prefer have basically two characteristics. One is figure out a way to make people better informed, which is a really hard thing to do. And the second is you have to have people have money at risk. You're not allowed to do this unless you have and I don't know what the right amount of money is. As opposed to, I still am the economist, and I think when government tries to prescribe in a detailed fashion what people should do, I think that tends not to work particularly well, because the central government hasn't sufficient omniscience to get to that level of detail.
I think we'll, maybe we should, one more question, or, yeah?
You draw mostly story about institutional failure, but the other part where economics doesn't really come into play is just mass psychology, and how much economists really have to face up to the fact that a lot of this, the institutions allowed it, but in part of this is that there was a bubble mentality where people forgot that housing prices come down. I can't believe how many conversations I've had in the last 10 years when I tell them housing prices come down. You got to be concerned about that. And no one would ever listen to me. And then that leads to a policy proposal. I just want your reaction. Schiller has proposed that the government should have a proactive policy that when you see a bubble psychology, so when some ratios like median income to median housing prices go way off charts, that the government, it not necessarily regulate, but really come in with an information.
In principle, I kind of like that idea. And Schiller is refreshing in his look at experimental and behavioral economics in what he writes. The problem is, what is the right point at which to do it? So the Bank of Japan did that in 1989. And in retrospect, that looks like they made a pretty big mistake, because the economy has really never recovered from that. And maybe it's just that the bubble was so big that it was never going to recover from it anyway. But we have this problem of observational equivalence between we had a bubble in Japan and we had a very provocative response to it on the part of the Japanese central bank. I mean, they made it a policy to deflate both the housing market and the stock market in Japan. And the Japanese economy has just never restarted since then. So, can you really pull it off? I think is a really tough question. But you're right about the bubble.
Wonders if we sort of had an additional set of leading indicators that we use that were more based on these kinds of ratios that we just reported every single month, so that if you paid attention, you could start to see where there are gaps occurring.
Yeah, but that's asking a lot of people to pay attention to that. I just can't, Martin, anybody watch Entourage, HBO show? Okay, well, to me, the thing that told me that there should have been a bubble, we should have all known a bubble coming, was in 2004 there was an episode where Vince just turned down a blockbuster movie and decided to buy a $10 million house. And the reason he's decided to buy the $10 million house is drama says, well, it's California, $10 million this year, it'll be worth $20 million next year. And Turtle says, so if you don't know the show, Turtle is this kind of loser guy, says, I know a guy with cheap money. There'll be no problem getting the house. So, it's, there you had the bubble all wrapped up in a 30-second conversation on HBO.
I think it's spectacularly interesting, especially as it refers to the future of scholarly work. Because I think that's really I think of the Meltdown as the occasion for the future scholarly work. Whatever your ideological presuppositions.
Right. Well, there are two questions I now want to ask all homeowners. I wish we could just ask this when they bought their house. How much do you think your house is going to increase in value next year? Not any just what do you think? And how important is it to you what's the value to you just of being a homeowner? Because I think that does, in 2005, everybody in San Francisco should have been selling their house and renting, right? Financially, it made no sense to be owning a house in San Francisco at that point. Yet almost nobody does that. Okay, why is it? Is it because moving is painful? Maybe that's it. Having just moved, I never want to move again, ever. Okay, but the other thing, I think owning, the idiosyncratic characteristics of your house, the way you make it your house, is something that really matters a lot to people, and that has value to it. But how much value, I have no idea, and we haven't really thought about that.
There's this added complexity that very few people I really seem to understand is that not only mortgage is complicated, but buying a house is really complicated because it's this weird package of an investment and housing consumption. And all of a sudden, I think in the last 10 years, people didn't understand that they were buying a place to live. They were just completely thought about it as an investment. Plus, it's the only place that normal people like me can buy something leveraged 5-to-1.
But I think you hit on something. I think if people's attitude toward housing was always that it was about a place to live. It's a consumption. It's a durable consumable. It's like a washing machine or a car, only longer. Right? Nobody thinks of their car as an investment because your car depreciates, right? Well, houses, the physical part of houses depreciates too. It takes longer, but it does, unless you reinvest in it all the time. Just like, cars, you can put in a new engine every 10 years and a new transmission every 7 years and keep it going if you really want to. A house is about having a place to live that you have control over. And I don't dismiss, I think the control over your living environment really is an important part of the package. But don't look at it as an investment. Because over the long haul, housing is a terrible investment relative to almost anything else you can do.
Let's continue this discussion. I want people who need to leave to be able to leave. It's been spectacularly fun.
Thank you.
And
well, thank you for inviting me, Mark.
And we're going to look forward to hearing more of this because I think it's very promising about the future intellectually.